Hello friends, my name is Sharon Bhagwani from class 11th F and my topic is Theory of Accountancy. Content: Introduction to Accounting, Basic Accounting Terms, Theory base of Accounting and Basis of Accounting. First, Introduction to Accounting. Definition of Accounting: it is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating financial information to the users. It shows the profit earned or loss incurred during the accounting period, value and nature of assets, liabilities, and owner's equity. Example is capital. Characteristics and objectives of accounting. Characteristics: first, identification of financial transactions and events. It means accounting records only those transactions and events which can be measured in terms of money, like example, purchase of raw materials or sale of finished goods by a firm. Second, measuring the identified transaction. Third, recording. Accounting is an art of recording business transactions in the book of account. It is a process of recording business transactions of financial character in the book of original entry. Fourth, classifying. It is the process of grouping transactions or entries of one nature at one place in journal or subsidiary books in ledger and then posted into ledger. Fifth, summarizing. Sixth, analyzation and interpretation. 7, communicate. Now we will see advantages and disadvantages of accounting. Merits: first, financial information about business. It tells us profit earned or loss incurred and also the financial position at the end of the accounting period. Second, facilitates comparative study. A systematic records enables a businessman to compare one year's result with those of others' years. Third, evidence in court. Systematic record of transaction is often accepted by the court as a good evidence. Fourth, facilitate sale of business. If someone desires to sell his business, the accounts maintained by him will enable the assessment of the proper purchase price of the business. Now, disadvantages. Accounting is not fully exact. In spite of the fact the most transactions are recorded only on the basis of evidence, like example, value of closing stock, doubtful debts, etc. Accounting ignores the quantitative elements, means it is confined to only monetary terms. Monetary terms means only money terms are accepted, like quality of skills of management, staff, industry relation, public relations are ignored. Now, third point, unrealistic informations means it is taken that business will continue for a foreseeable period. Future going concern concept also tells us the same. Now, we will see accounting process. It is the process: step 1, identification; second, posting in journal; third, post to journal to ledger; then prepare and unadjusted trial balance; fifth, prepare worksheet; sixth, recording; seven, adjusting trial balance; step 8, prepare financial statement; step 9, closing entry; step 10, post closing trial balance. And this is one another: identifying, recording, then classifying, preparing, and communicating. Now, difference between bookkeeping and accounting. First point of bookkeeping. It is a process through which financial transactions are identified, measured, recorded, and classified. And first point of accounting. Accounting is a system of recording, classifying, summarizing, and interpreting financial information. This information is recorded and classified through the bookkeeping process. In bookkeeping, there is no summarizing and interpreting. In accounting, it is summarizing and interpreting of financial information. Bookkeeping. It is the first step and considered as a base for accounting, and accounting begins with bookkeeping ends. Third, cannot be based on bookkeeping only, can be based on accounting. Bookkeeping helps to keep a systematic record of financial transaction. Accounting has an objective to ascertain the financial position. Financial statements are prepared after bookkeeping process. Financial statement of any entity are prepared on the basis of financial records obtained through bookkeeping. It does not require any special skills. Accounting, on the other hand, requires special skill due to its analytical and its complex nature. Now, basic accounting terms. First, business transaction. The term business transactions means a financial transaction or economic event entered into by two parties that initiates the accounting process of recording it in the books of account of an enterprise. It is concerned with money terms like goods or services. It arises out of transfer of exchange of goods and services. It has dual aspects like receiving one is debit and giving credit. Second, account. Account, it is a record of transaction, cash and credit both transactions under a particular head of account. Say like salaries, telephone expenses, electricity expenses, etc. On a particular head like assets and liabilities. Third, capital. Capital is the amount invested in an enterprise by the proprietor in case of proprietorship or by partnership. It may be in the form of money or assets having a monetary value. Third, drawings. It is the amount withdrawn or goods taken by the proprietor or partner for personal use. Drawing reduces the investment or capital of the owner. Liabilities. Liabilities means amount owned or payable by the business. Liability towards owner or partners of the business is termed as internal liability. On the other hand, liability towards outsider is termed as external liabilities. External liabilities arises because of credit transaction, example, bank overdraft, long-term borrowings, etc. Liabilities are of two types, non-current liability and current liability. First, non-current. Non-current liability is that liability which is payable after a period of more than a year from the end of accounting period. It is a long-term security. Example, debentures, long-term loans. And current liability is that liability which is payable within 12 months from the end of accounting period. Example, short loans, bill payables, etc. Now, assets. Assets are the properties, tangible or non-tangible, owned by an enterprise. There are current assets, non-current assets, fictitious assets, and recipients. Current assets. They are those assets which are held by an entity or enterprises with the purpose of converting them into cash within a short period. Example, goods are purchased with the purpose to resell and earn profit. Now, fictitious assets. They are losses not written off in a year in which they are incurred, but in more than one accounting period. Example, advertisement. Now, recipients. It is the amount received or receivable for selling assets, goods, or services. Now, there are revenue receipts and capital receipts. Revenue receipts are the amount received or receivable in the normal course of business, say against sale of goods or rendering of a services. Now, capital receipts and expenditure. Expenditure is the amount spent or liability incurred for acquiring capital goods or services. There are three types of expenditure: capital expenditure, revenue expenditure, and deferred revenue expenditure. Expenses. Expenses is the cost incurred for generating revenue. There are two types of expenses: prepaid expense that pay in advance, and outstanding expenses that has been incurred but has not been paid. Now, income. It is the profit earned during an accounting period. The difference between revenue and expense is termed as income. We get income is equals to revenue minus expense. Now we will see what is profit. Profit earned by the business from its operating activity. Profit means income earned by the business from its activities like sale of goods, rendering of services. For profit is further divided into two forms: gross profit and net profit. Now, gain. Gain is increase in owner's equity resulting from something other than day to day earning from irregular or non recurring nature. Now, loss. Loss is excess of expenses of a period over its revenue. Example: goods lost in theft. Now, purchase. Purchase is used for an account to record purchase of goods or raw materials for resale or for producing products which are also to be sold. There are two types of purchases: credit purchases and cash purchases. Goods purchased for cash are termed as cash purchases, and goods purchased on credit are termed as credit purchase. Now, what is purchase return? Goods purchased may be returned to the seller for any reason. This is termed as purchase return or return outward. Now, what is sales? The term sales is used for selling of goods. When goods sold for cash are termed as cash sales, and goods sold on credit are termed as credit sales. Now, goods sold when returned by the purchaser are termed as sales return. Now, what is goods? Goods are the tangible things, physical items of trade that are purchased to be sold. Now, stock or inventory. It is a tangible assets held by enterprises for the purpose of sale in the ordinary course of a business, for the purpose of using it in the production of goods. There are two types of stock: opening stock and closing stock. Now, trade receivable. It is the amount receivable for sale of goods or services rendered in the ordinary course of business. Amount received for sale of goods. Now we will see trade payables. It is the amount payable for the purchase of goods or services taken in the ordinary course of business. Cost. Cost is the amount of expenditure incurred to a specified article, product, or activity. Voucher. Voucher is an evidence of a business transaction. Example of voucher are recipient, debit and credit notes, cash memo. Now, discount. It is reduction in the price of goods or from the amount to be paid to a customer by an enterprise. Discount may be of cash discount or trade discount. Now, bad debts. Bad debts are the amount owed of the business that is written off because it has been irrecoverable. Credit means right side of the business means giving, and debit means left side of the amount when we will receive the amount. Now, depreciation. It is the fall in the price of fixed assets because of usage or accident. Insolvent. When in person or enterprises which is not in position to pay its debts. Theory base of accounting. Fundamental accounting assumptions. First, going concern assumptions. It is assumed that business shall continue for a long time. Example: loan or expenditure that will give benefits for a longer period and revenue expenditure. Now, second, consistency exceptions. In this, accounting practices once selected and adopted should be accepted consistency year after year. They are the policies which remain continue from one year to year another. It is regular basis, example stock or depreciation. Third, accurate assumptions. This transaction is recorded in the books of account at the time it is entered into and not when the settlement takes place. Accounting principles. First, accounting entity or business entity principle. According to this, business is considered to be separated from its owner. It is recorded in the books of account from business point of view. And proprietor is termed as creditor to the firm. Capital is the identity. Second, money measurement terms. In this principle, only those terms are recorded which are capable to record in the forms of money. Example, sale of goods, etc. Accounting period principle. The life of an enterprise is broken into smaller periods, usually 1 year, which is termed an accounting year. Accounting period. The financial year is 12 months, 1 April to 31st March. Now, fourth, full disclosure principle. In this, there should be completely and unstable reporting on the financial statement of all significant information relating to the economic affairs of the entity. Fifth, materiality principle. An item should be recorded as material if there is a reason to believe that knowledge of it would influence the decision of an informed investor. Sixth, prudence or conservatism principle. Do anticipated profit but provide for all possible losses. It is policy of playing safe. Seventh, historical cost principle or cost concept. An asset is recorded at the cost of the time of its purchase but is systematically reduced by charging depreciation. The market value of an asset may change with the passage of time. Now, matching concept. According to this principle, all costs which are applicable to revenue of period should be charged against revenue. Dual aspect or duality principle. Every transaction entered into business has two sides, a debit of receiving and credit of giving of equal amount. Now, revenue recognition concept. According to this, revenue is considered to have been realized when a transactions have been entered into and the obligation to receive the amount is established. Last but not the least, verifiable objective concept. It means all accounting transactions should be evident and supported by business document. Verify with proofs. Now, basis of accounting. Difference between accrual and cash basis of accounting. In accrual basis of accounting, both transactions are recorded cash and credit. In cash basis of accounting, only cash transactions are recorded. Second, prepaid and outstanding expenses are accounted for in the profit and loss account. Accrued income and income received in advance are accounted as shown in the balance sheet. And in cash basis of accounting, prepaid and outstanding expenses are not adjusted. Similarly, accrued income and income received in advance are not adjusted. Last, bibliography from where I have taken this information. First, internet. Second, YouTube. Third, guide of T.S. Graver. Thank you. Have a nice day.